Have you ever been promised high returns on your investments? A proposition so enticing that it seems almost magical? Well, as the old saying goes, if something seems too good to be true, it probably is. In the world of finance, these too good to be true propositions often take the form of Ponzi and Pyramid schemes. Today, we delve into these financial black holes, unmasking their deceptive allure and equipping you with the knowledge to steer clear. Ever heard of Charles Ponzi? He was a swindler who lived in the early 20th century and whose name now defines one of the most notorious types of financial fraud, the Ponzi scheme. A Ponzi scheme works on a simple yet deceptive principle. Initial investors are paid returns, not from genuine profits, but from the money contributed by later investors. This creates an illusion of a profitable business, enticing more and more people to invest their money. The scheme, however, is unsustainable. Once the flow of new investors slows down or stops, the scheme collapses, leaving the majority of participants at a loss. On the other hand, a pyramid scheme functions a bit differently. In this type of scheme, each participant recruits others to invest money into the scheme. The returns for the early participants are paid out from the investments of the new participants, rather than from profits of the scheme. The pyramid scheme, much like its Ponzi counterpart, is unsustainable. When the recruitment of new participants falters, the pyramid crumbles, leaving most investors out of pocket. Both Ponzi and pyramid schemes rely heavily on the constant influx of new investments to keep the illusion of profitability alive. Neither generates any real profit or value. They are unsustainable, unethical, and in most jurisdictions, illegal. They thrive on ignorance and greed, promising high returns with little to no risk. To summarize, Ponzi schemes pay returns to early investors from the investments of later participants, creating an illusion of a profitable business. Pyramid schemes, on the other hand, depend on each participant recruiting others to invest. Both types of schemes are unsustainable, as they rely on a never-ending influx of new investors. They generate no real profit or value, and when the flow of new investors dries up, the schemes collapse, leaving most investors at a loss. In the world of crypto investments, these schemes can be particularly dangerous due to the relatively unregulated nature of the market. So the next time you come across an investment proposition promising high returns with little risk, remember Charles Ponzi and his ill-fated investors? Remember the pyramid schemes that crumbled, leaving countless investors penniless. Remember, if it sounds too good to be true, it probably is. Be vigilant, do your homework, and invest wisely. After all, your financial future is in your hands.